So we began with IFRS 15 last week, revenue from contract with customers. I will try to lay the foundation for this standard. I know those of us at final that you are doing CR, you are familiar with what standard is. When we talk about standards, that is International Financial Reporting Standards. We treat them one by one. They are the ones that actually regulate how transactions should be treated. And now items that will be included in the financial statement should be treated. That is, we deal with issue of recognition, the inclusion of a transaction in the financial statement. We deal with measurement, that is, at what amount do we recognize a transaction in the financial statement. Then we deal with presentation, which talks about in which book of the financial statement should each transaction appear. Then we deal with disclosure, which is like notes the account to enhance the understanding of those who might not be technically inclined on the terms on financial terms when they pick a financial statement. So we started with IFRS 15, revenue from contract with customer, and we move on to laying the foundation of defining the items in the standard. We talked about the 5-step model from step 1 to step 5. And we treated the step model last week, dealing with them from step 1, identify the contract with the customer. Step 2 talks about identify the separate performance obligation in the contract. Step 3 talks about determine the transaction price. That is, at what price do we recognize each transaction. And then step 4 talks about allocate the transaction price to the performance obligation. And step 5 talks about recognize revenue when or as an entity satisfies performance obligation. So this morning we are moving on, talking about, because when we concluded on step 5, we try to define what a performance obligation is, and we talk about how it is satisfied. That a performance obligation might be satisfied, that is, goods and services might be transferred over time, in which case revenue will be recognized over time, or at a point in time, in which case revenue is recognized at that point in time. So this morning, we are moving on to performance obligation satisfied over time. Performance obligation satisfied over time. See, a company might identify at the inception of the contract whether a performance obligation will be satisfied over time or at a point in time. A company transfers control of a good or service over time, therefore satisfying a performance obligation and recognizing revenue over time if the following criteria is met. That is, the list of these criteria that we have here are the criteria that must be met before performance obligation is recognized as satisfied over time. Number 1, the customer simultaneously receives and consumes the benefit provided by the entity's performance as the entity performs. That is, you are rendering service and the customer is enjoying the service. Just like this relationship we have, the training you are attending with me, Night of Business Consult, is a performance obligation satisfied over time. And we'll be seeing how the transaction should be treated under this standard. As I'm rendering service, you are enjoying the benefits, so I can demand payment as the service is going on. Of course, the transactions will not end until the diet session is over. But as I'm rendering the service, you are enjoying the service simultaneously. That is performance obligation satisfied over time. The company's performance creates or enhances an asset, for example, work in progress, that the customer controls as the asset is created or enhanced. You can see as we render the service, we put in the video there, which you can enjoy as you are also paying. So it's the relationship we have under this training is a performance obligation that is satisfied over time. The company's performance does not create an asset with an alternative use to the seller, and the entity has an enforceable right to payment for performance complete to date. You see, me rendering the service to you now, I have an enforceable right to payment for the performance I have, the performance have discharged till date, completed till date. So if a performance obligation is satisfied over time, an entity needs a mechanism to identify the extent to which the performance obligation has been met. So there should be a way for me to know when the performance obligation has been met, when I've actually delivered what we have agreed on as we move on in this relationship. So I'll be using this, our relationship, the training, we're having this online class as an example of performance obligation satisfied over time. So example, performance obligation satisfied over time. These are examples. Say X Limited enters into a contract to provide monthly payroll processing services to a customer for 1 year. You can see the question says, is the performance obligation satisfied over time? Then we analyze A, does the customer simultaneously receive and consume the benefits provided? The answer is yes. Because as you are rendering the service of payroll every month, the customer is enjoying your service as the time is going. So it means that criteria is met. B, does X Limited performance create or enhance an asset that the customer controls as it is created or enhanced? The answer is yes also, because as I render payroll service for you in January, you enjoy the benefits. I render it for you in February, you enjoy the benefit. Even though the contract we signed is 1 year contract, as the service is ongoing, you are enjoying the benefits. So the asset being the ability to process the payroll. C, does X Limited's performance create an asset with an alternative use? No, the asset is not with an alternative use, because the service is it is actually meant for the payroll. You are enjoying it. It's not as if it can be used for something else. So it is strictly payroll processing. And does X Limited have an enforceable right to payment for performance completed to date? Yes, because as you are enjoying the service, the company has the right to pay, to receive money from the customer, because it is done and the customer is also enjoying the benefit. Conclusion, the performance obligation is satisfied over time. So because all the three criteria is met, so there will be no need. There will be no need to there will be no need to consider criteria B or C once criteria A was met. Only one criteria needs to be achieved. It is very, very important. Good morning. Mr. Ogunle, good morning, sir. Mr. David, you are welcome. Mr. Ogunle, I don't understand. No link to join. Oh, does that mean you can't connect to the class? I don't get it. Please, Mr. David, can you see the screen? Can you hear me clearly? And Juliet, can you see the screen? Can you hear me clearly? I want you to respond. Ms. Ogunla is saying there's no link to join class. I don't. Please, I need you to respond to know the state of the question. Okay, Juliet said yes, David says yes. So, Ms. Ogunla, what is the challenge? Let me quickly check for her. No link to join. You are already in class, and I've even added you to the video. Please, 1 minute. Let me quickly attend to her, and I'll see exactly what the challenge is. Let me pause this recording. Okay. Just 1 minute, please. I just need to know exactly what the problem is with her. Minutes, please. Okay. So hopefully she will find her way around now. let's go back to the class. So, like I was explaining, the performance obligation is satisfied over time because those criteria that is set is actually met, and because the criteria is met, we say performance obligation satisfied is satisfied over time. Then the second one is performance obligation satisfied at a point in time. That's different. If a performance obligation is not satisfied over time, then it is satisfied at a point in time. For instance, you want to buy a pair of shoes, even though the company is just going to make the shoe for you, a particular specification that you have discussed with them. So it is when the asset is transferred to you, that is the goods, is transferred to you, and you, being a customer, start enjoying the benefits. You have control over it. That is when the performance obligation, it is that point in time that the company can recognize revenue. So if you make payment in advance for a shoe that will be constructed for you, the company cannot recognize revenue. That money is a liability in their hand. It is when the transfer of ownership of the shoe becomes is done to you that they can now recognize revenue. So that's the difference between performance obligation. But if it is a performance obligation satisfied over time, as you are enjoying the benefits of the service rendered to date, the company can also start recognizing revenue based on the service rendered to date. So we talk about measuring. So the issue, the aspect that actually requires technicality, it is when performance obligation is satisfied over time, because you need to know how to measure it. How do you recognize revenue? How do you allocate this revenue to this time? The apportionment of this revenue to the time that is involved. So measuring progress towards complete satisfaction of a performance obligation. For a performance obligation satisfied over time, revenue is recognized by measuring the progress towards complete satisfaction of that performance obligation. One, a single method of measuring progress should be used for each performance obligation, and that method should be applied consistently to similar performance obligations and in similar circumstances. Two, progress must be remeasured at the end of each reporting period. We must be able to measure the progress at the end of each reporting period. The progress of the performance we have done to date must be measured at the end of each reporting period, because revenue will be recognized in the financial statement. So if you sign a contract that will be for 3 years and you are rendering the service every year, at the end of each year, you should recognize revenue based on the performance you have done till date. So next we go to methods of measuring performance. We say possible methods of measuring progress includes the output method and then the input method. The output method and the input method. So the two methods of measuring performance obligations satisfied over time is the output method and the input method. So we talk about the output method first. The output methods recognize revenue on the basis of direct measurement of the value to the customer of the goods or services transferred to date relative to the remaining goods and services promised under the contract. So we have an agreement, for instance, that I am going to supply you 100 pairs of shoes. You are a dealer, you are selling shoes, I manufacture shoes. And you are being a customer, being my customer, we agree that you want to, I should manufacture 100 pairs of shoes to you. And now I want to use, as I'm manufacturing the shoes, I'm transferring them to you. The contract that you are paying me for is going to be for the 100 shoes. But if I want to recognize my revenue using the output method, I will recognize it based on how many pairs of shoes have I transferred to you till date. So if at the end of December, maybe you signed the contract with me in August, at the end of December, I want to prepare my financial statement. I need to recognize revenue in respect of that transaction I have with you. So if I'm using the output method as at 31st December, even though the contract is to elapse the following August. Okay, you signed with me in August, it will elapse in July the following year. But as at 31st December, I need to recognize revenue I will look at the numbers of the pairs of shoe I have transferred to you up till the end of December, the first year, and then I recognize revenue based on that. That is output method, using the output method to measure revenue. So output methods include methods such as survey of performance completed to date, appraisal of results achieved, milestones reached, time elapsed, and units produced or units delivered. You can see that last point identifies with the example I just made now. That is the units delivered to date. And if in contract, for instance, I work in a construction company. This week now, we've been constructing a particular road for Lagos State government, and we needed to measure how much we have done to date, to know the claims we need to make from government. So we have to bring in professionals who will help us to determine what's the level of performance. And then the government also has a way of measuring it to know, okay, we have done 60%, okay, we have done 70%. And so as a result of that, we are entitled to receiving revenue. We are entitled to receiving revenue based on the performance we have done till date, based on the performance we have done to date. So that is how to do it using the output method. The output should faithfully depict the entity's performance towards complete satisfaction of the performance obligation. So output must depict our performance. The disadvantages of output methods are that the outputs used may not be directly observable, and the information required to apply them may not be available without undue cost. That's truth. For instance, we knew how much we had to incur as cost to bring in people, professionals who will help us determine how much performance we have done to date. For some contract, it might be easier for you, even not having some technical skills, to know the level of performance. But for some, to know the level of performance, you must bring in a professional who will help to measure how much you have performed till date before they can now say, okay, this is the level of performance. So it has its own disadvantage. Therefore, an input method may be necessary. So most people use the input method. Let's see the conditions for input method now. Input methods. Input methods recognize revenue on the basis of the entity's effort or input to the satisfaction of a performance obligation by comparing input to date to the input expected. That is the input expected, input to date to the expected total input. So I gave an example when I was taking a class at the time. For instance, you just won a contract to supply textbooks to all the secondary school in a particular local government. If you want to use output method on a particular measuring date, and you know that the schools in the entire local government, for instance, there are 100 schools, you will know the number of schools you have supplied textbooks to till date using the output method. Or if it is input method, let's say the contract, for instance, is 10 million naira, for instance. That's the contract price as a whole. And you, being an expert in supplying textbooks, you have done your analysis and you know that everything will cost you 6 million naira to supply all the textbooks, to all the schools. So your profit that you have projected from the beginning of the contract is 4 million naira. You have had that projection. So on a particular date, you want to use input method to measure your performance to date. You will look at how much of that 6 million naira you have incurred in expenses, using the cost to determine how much you have done. So if you are to, the entire cost over the life of the contract, that is supplying the books, will be 6 million naira. And on a particular date, you have incurred 2.5 million naira. And you want to measure revenue as at that date that you have incurred 2.5 million naira. The reason why we are using the method to measure is because the time period for you to complete a contract may not align with your own accounting year. You sign up a contract in January, the contract will terminate in December. That is easier for you to measure if your 31st December is your year end in financial statement. But you sign up a contract in June. The contract is for 1.5 years, and it's it's for one year, for instance, and it's going to elapse the next May. And as at 31st December, which is your year end, you are trying to prepare financial statement. Revenue must be recognized on the performance you have done to date. So using input method, for instance, that 6 million naira, you have incurred 2.5 million. You are going to be doing what? 2.5 million divided by 6 million times 100. That will give you the percentage of your performance to date. That percentage is what you will use to multiply the contract price, which is 10 million, for you to know the amount of revenue to recognize. We'll be taking an example to do all this. We're just trying to lay the foundation for our knowledge. So, for example, labor hours expended relative to total expected labor hours to satisfy the performance obligation. Two, cost incurred relative to the expected total cost, you can see, to satisfy the performance obligation. Then it may be appropriate to recognize revenue on a straight line basis where they are expended evenly throughout the performance period. So we have here some definitions of terms that we need to have. Okay, let me just do something here. Looks cumbersome, so let me move some things to sorry, 1 minute. I tried to put this thing together here, but looking cumbersome. So let me move some here so that it will be easier for us to see and I also try to put the lecture notes in the classroom so that it will be easier for us. Maybe I've not when I have not put this last one, I will try and put it. It will be easier for us to study using the lecture notes. Using the lecture notes. 1 more minute, please. I'm trying to make sure I want it to be visible, that everybody will see it clearly. I want it to be visible so that you see it clearly, because there are important concepts we must understand in the course. So we talk about contract liability and contract assets. We need to understand these definitions before we go into calculation. A contract liability is recognized and presented in the statement of financial position, where a customer has paid an amount of consideration prior to the reporting entity performing its obligations. You receive money in advance, and that obligations you have that you signed with the customer has not been performed to any extent yet. So you have contract liability. That is, a contract liability is recognized when a customer has paid part or all the amount of the consideration before the reporting entity transfers control of the related goods or service to the customer. Simply put, recognize contract liability when customer pays for goods or services in advance. And then the next one is what we have as contract asset and receivable. Contract asset and receivable. So a contract asset or receivable is recognized where the reporting entity has performed its obligation, but the customer has not yet paid the related consideration. You have performed the obligation, but you have not collected money. That's contract asset. A contract asset is recognized when the reporting entity when the reporting entity's right to consideration is conditional on something other than the passage of time. For instance, conditional on future performance. So the difference between receivable and contract asset is that receivable is not conditional. Before you can call it a receivable, you have sent invoice to the customer and you are checking the difference between the amount of money you have collected and the amount of invoice you have sent to recognize receivable. But for contract asset, you are checking the performance you have done to date and the difference between that performance and the invoice you sent to customer. So there may be additional conditions why you cannot recognize contract asset as receivable, because receivable is what? The condition only on receivable is that it is due to the passage of time. That is, you are just waiting for the customer to pay. You have done everything you need to do. But for contract asset, you render a service to a customer, you have not sent invoice to that customer. The customer is not even aware that is owing you. So, and you have done your performance. That is a contract asset. So, a contract asset is conditional on something other than the passage of time, but a receivable is recognized when the reporting entity's right to consideration is unconditional, except for the passage of time. That is the only reason why you have not collected money is because you are waiting for the time that the customer will pay. That is that the relation between that. And so where revenue has been earned and invoiced, you can see the reporting entity will recognize receivable. You have sent the invoice, you have earned it, and not a contract asset. And not a contract asset. Sorry, let me just correct something here. And not a contract asset in a statement of financial position. However, when revenue has been earned but not yet invoiced, you can see the reporting entity will recognize contract asset and not receivable in the statement of financial position. Quickly, let's take this first example. This example is on ABC Limited. ABC Limited, let me try to enlarge it so that we can see clearly from our hand. It's on ABC Limited. ABC Limited. So the information we have says ABC Limited is a company involved in the building industry. During the year ended, during the year ended 30th April 20X5, the company commenced a contract which is expected to take more than one accounting year to complete. The position of the contract as at 30th April 20X5 is as follows. So agreed contract price, this is it. Contract cost to date is 16 million. So, okay, let me just change this to Naira for purpose of clarity. So we have 50 million is the contract agreed price. Cost to date is 16 million. Estimated cost to complete the contract is 24 million. Agreed value work completed is 25 million. Amount invoiced to date is 26 million. Cash received is 24 million. So you are required calculate the performance obligation satisfied to date. That is the percentage of contract completed using one, the input method, that is using the cost method, and two, the output method, using the value of work satisfied to date. So we will work on that now using our worksheet. This is also, we are still on IFRS 15. IFRS 15, I can call this one true for purpose of proper numbering. So we're having our example one. Example one. And we are talking about measuring input and output methods of measuring input and output method of measuring performance. Performance. Input and method of measuring performance. Let me wrap that and put it properly here. That's the topic we are working on. So this example talks about for purpose of okay, you can see agreed contract price is 50 million. So let's use the input method. We want to use the input method now. So we are working on input method now, which is what? Input method. Input method. So, and the explanation we had is that when you are using the input method, even the question has given us the guidance that we use cost. We use cost to determine the input method. We use cost. So, to know the method of measurement, you see contract cost to date, 16 million naira. Estimated cost to complete the contract is what? 24 million naira. So, if we want to, that's what we're going to be using as a basis for our measurement. So, contract cost to date. So I put the naira sign here, rounded to the nearest thousand. So cost to date, contract cost to date. Contract cost to date, based on the information we have, is what? Let me check again. 16 million naira. 16 million. So we put it there, 16 million. Then cost to complete, that is estimated cost to complete the contract. Estimated cost to complete the contract is 24 million. So let me put the information here. Estimated cost to complete. That one is 24 million naira. 24 million naira. So first, we determine the total cost of the contract, because this is how much you have spent and this is how much remaining to for you to spend. So how much is the total cost of the contract? We add the two together to get what we have as the total cost of the contract. The total cost of the contract, therefore, is 40 million naira. 40 million naira is total cost of the contract. So what are we going to be doing with this? To calculate the percentage of cost we have spent to date, we are going to be dividing the total, we are going to be dividing cost to date with the total cost of the contract. So let me just put that in the right perspective. So percentage of completion using input method, percentage of completion using input method. The percentage will be what? We are going to be having cost till date, formula cost till date divided by total contract cost. Total contract cost. That's it, times 100. So the formula is, let me wrap it, trying to make sure we have so this is just division, the slash there is division. So how to calculate that now is now percentage of completion will now be equals to cost to date 16 million divided by the total contract cost, which is what? 40 million, and times 100 times 100. That is the input method. The percentage of completion of this contract, therefore, is 40 million. Percentage of completion, percentage of completion. Using the input method, percentage of completion is what? Based on what we have just explained now, the percentage of completion is 40%. And how did we arrive that? Cost to date divided by the total contract cost. Cost to date divided by the total contract cost. 16 million divided by 40, and we have 40%. That is input method. If you want to use the output method, so the question gives us, we are going to be using the value of work certified. You can see agreed price, contract cost to date, estimated cost complete, agreed valued work complete, agreed valued work complete. And this is how much? The value of the work complete is 25 million naira. And that we are going to be using that to divide what we call the total contract cost. You can see the total contract cost, which is what? 50 million naira. So if you say, okay, work we have agreed that you have performed is 25 million, and work, the entire total contract cost is 50 million. So the percentage of completion is going to be what? 25 million divided by 50 million. So using the output method, using the output capital, using the output method. It's going to be what? The formula for output method, the percentage of completion, percentage of completion, the percentage of completion will be what? Sorry, let me check. Yeah, okay, no information yet. I hope Mrs. Ogunleye has joined us. Has she? Yes, you are in now. You are welcome. Okay, using the percentage of completion, so we are going to be having what? The formula for that is going to be what? Work certified, that is the formula based on this information, value of work complete divided by total contract cost. So it's going to be what? Value of work completed divided by, let me put it down, divided by total contract price. And that's going to be what? Sorry, I'm supposed to put. Let me put it in the right perspective. So value of work done divided by total contract price times 100 over 1 times 100 times 100. So, and how do we calculate that? What is the percentage of work done that is complete? So I'm going to be picking this information here. Agreed valued work completed. Agreed valued work completed. Agreed valued work completed, which is how much based on the information in the question is coming. Sorry. 25 million naira. 25 million naira. 25 million. 25 because it is rounded to the nearest thousand. So it's 25,000 we are writing. Let me link the rounding there. It's 25 million naira. Agreed work completed. Total contract price. Total contract price. Total contract price is how much? Based on the question, it's 50 million naira. Total contract price is 50 million naira. 50 million. So if you are now calculating what is the percentage of completion using the output method, it's going to be what? We're going to be having the formula here. So let me just put this one equals so that the presentation can be done. The formula will now be what? It will be equals to 25 divided by 50 million, 25,000 divided by 50, and then the percentage of completion is 0.5 times 100 times 100, and we have 50%. I guess we now understand the difference between the input method and the output method. The input method will use the cost incurred to date, and the output method will use percentage of the value of work complete till date. That is the difference between the method. That's the difference between the method in case you are asked in examination to use the method, both input method and output method, to measure contract, the value of work completed to date in a contract. That's going to be what you are going to be using as a method of measurement, as a method for measuring them. So quickly, let's do the second example. The second example. So that's about that. Although there are other information I would have needed, but the second example will be more explicit. Example 9, we're talking about Prince PLC. Prince PLC is a company whose activities are in the field of major construction projects. During the year ended 30th June 2022, it enters into 3 separate construction contracts, each with a fixed contract price of 2.5 million naira. The following information relates to the contracts as at 30th June 2023. Amount invoice to customer is 1 for contract X, because there are 3 contracts. You can see contract X, contract Y, contract Z. So the amount invoice to customer is listed there. For contract X is 1,150,000, and then this one is 900,000 for Y, and for contract Z we have 1,050. And we have cash received is listed there. We have cost incurred to date. We have estimated cost to complete the contract, and we have estimated percentage of work completed. So we now have a particular thing they want us to note in the question. They said the statement of profit or loss for the period ended 30th June 2022 includes revenue and cost of 60. Okay, this is also expressed in dollars. Let me just put it in naira for purpose of so that we can have a seamless. Let me just put it in naira. Put it in naira. Sorry. Just 1 minute. I'm trying to put it in naira and work it the way it should be. We are Nigerians, so we'll use our naira to calculate. So they said the statement of profit or loss for the period ended 30th June 2023 includes revenue and cost of 650,000 naira and 550,000 naira respectively in respect of contract X required. Show how each contract will be reflected in the statement of financial position of Prince PLC as at 30th June 2023 under IFRS 15 revenue from contract with customers. 2. Show how each contract will be reflected in the statement of profit or loss on and other comprehensive income of Prince PLC for the year ended 30th June 2023 under IFRS 15 revenue from contracts with customers. So we are supposed to show how these transactions will reflect in the financial. So I'll first give us the procedure for treating a transactions like this when it's complicated before I start solving it, because this seems to be a more comprehensive test on IFRS 15. So, and it involves 3 different contracts. So let's look at the procedure. Steps for solving this question. Step 1, determine the percentage of completion. That's the first step. So the first thing you're going to be doing in your first step is what? Determine what is the percentage of completion of this contract, depending on the method you want to use. And I think they gave us in the question, okay, you can see estimated percentage of work completed. They have given us in the question. So that step is solved already, because this is 70% for contract X, 35% for contract Y, and 40% for contract Z. Then the next step will be what? Test for a future loss in the contract. That's what they call the onerous contract. I don't know if you have heard about it before. That's a contract in which the future cost to complete the contract will be higher than the contract price. The future cost to complete the contract will be higher than the contract price. You need to test every contract for an onerous contract. So test for future loss in the contract. That is, test if any of the contract is an onerous contract. Let me just put it there. There's an error here. Onerous contract. What's an onerous contract? An onerous contract is a contract in which the unavoidable cost of meeting the obligations under the contract exceeds the economic benefit expected to be received under it. So how do we test for an onerous contract? We look at the contract price as a whole. We look at cost incurred to date. We look at cost to complete the contract, and then we look at the difference between the two. If we see that the cost is higher than the price, then that is an onerous contract. And how is onerous contract being taught? Any future expected loss is treated as an expense in the current period. That is going to be treated in the example we have now. That is, you take a contract and the contract price is, for instance, 1 million naira. And after calculating your expenses based on some circumstances, you find that you're going to spend 1.1 million naira on the contract. On the date that you discover that that expense will be incurred in the future, and you are preparing your financial statement that day, that expense must be recognized today as an expense. That loss, the future loss, you have not incurred it, but it's projected as a loss, must be recognized as an expense in today's recognition of expense in respect of that contract. Step 3, calculate the revenue to date. You need to look at percentage of completion to multiply the contract price using the output method or input method. Since they have given us the percentage, so we don't need to be knowing whether it is input or output. We just pick the percentage they've given us to either multiply the cost incurred to date, or it is better to use percentage to multiply the price, the entire price of the contract. So calculate the cost incurred to date also, that is, add cost incurred to date to cost to complete the contract and multiply with the percentage of completion. That's how to know the cost to date. Cost you have incurred to date plus cost to complete the contract, then multiply by the percentage of completion. You know the cost incurred to date. And so calculate the revenue to be recognized in the financial statement, that is revenue to date, less any previously recognized revenue. Number 6, calculate the cost of sales to be included in the financial statement, that is cost incurred to date plus any computed future loss minus any previously recognized cost. So please, it's important, I will put this note in the chat after the class. You also watch this video, and I will maybe later I will try and get a question that will test all these things. You will see how we are going to be solving this problem one by one, and this is the steps for solving them. Next, Calculate the cost of sales. Okay, we have done about that. Number 7, calculate the contract asset or liability. Cost to date plus profit to date minus total loss on any onerous contract less any amount invoiced to customer. That is what we call contract asset. If positive, it is contract asset. If negative, it is contract liability. 8, calculate the trade receivable, amount invoice less cash received. So we will take this example and we'll be treating it one by one based on the principle. So we're having it as example 2. Example 2. Example 2. And we're going to be saying it's a complete test on IFRS 15, because it's going to be testing almost every aspect of that standard, and this will satisfy every question we are supposed to have in respect of this standard. So we are going to be having the companies listed, that is, sorry, the contract listed, contract X, Y, Z. So we're going to be having, so I have the heading here as contracts. Contracts. And so we have X here, we have Y here, we have Z here. So first we'll work with the first step. I want to follow the step as I gave it to us. What is the first step? Determine the percentage of completion. So we come under each contract based on the information they have given us in the question. For contract S, 70% completed. Contract Y, 35%. Contract Z, 40%. So 70, 35, 40. So we come here, we put percentage of completion, 70%. 70%. The other one is 35%, 5%, and the other one is what? 40%. 40%. Let's check it again if it agrees. 70, 35, 40. So the description here is that the percentage of completion, percentage of completion. They didn't have to do this because they gave us already in the question. So this is settled here. Now that we have settled this, let's go to the next task, step 2. What does step 2 say? So these are the steps. What does step 2 say? Step 2 in the question says what? In the guide says what? Test for future loss in the contract. That is, test if any of the contract is an onerous contract. It's an onerous contract. So we want to test if any of the contracts are an onerous contract. And how do we do this? We will calculate the contract price, and then we are going to be deducting all the costs expected from the contract. So for X and Y, so I'm going to be putting the money here, the contract price. So X, Y. So let me just put the Naira value, the monetary value here, so that we know that it's money we are using to compute here. So we know that the column is for S. I don't need to be putting S again. We know this column is for Y. We know this column is for Z. That's how we're going to be treating it. So contract price. Contract price. Contract price. So what's the contract price for X, Y, Z? The amount invoiced, the contract price they have given us in the question. You can see Prince PLC is a company whose activities are in the field of major construction. During the year ended 30th June 2022, it enters into 3 separate construction contracts, each with a fixed contract price of what? 2.5 million. So each of them is 2.5 million. So here we're going to be having 25,000 since I've rounded it, and that's the same thing for the remaining 2. We have the contract price put in place there. Then the next thing we're going to do is cost incurred to date. Cost incurred till date. What's the cost? What's the amount of cost incurred till date? We go to the question and pick it. Cost. This is cost incurred till date. So for X, for Y, for Z, those are the costs incurred till date. So let me see if I can copy them here. So this cost incurred till date. Cost incurred till date. Let me reduce the font because I copied them from that place. Cost incurred till date. So those ones, this one are supposed to also be in jacket because we want to deduct them. You don't forget it is calculation we are doing. We want to be deducting them. So this will be minus, and then this is also minus, and this is also minus. Then the next thing is cost to complete. Cost to complete. Cost to complete the contract, and then we go into the question. Cost incurred, the estimated cost to complete. You can see it here. Estimated cost to complete. So we pick the three figures. Estimated cost to complete. We come here and put it here. Estimated cost to complete. Let me also, since I'm bringing them, I just copy them. So putting them in the same font. So this is also negative. Negative. And this is also negative. And this is also negative. So we are looking at the difference between the cost and the contract price to know if any of these contracts is an onerous contract. An onerous contract is a contract in which the cost, estimated cost over the life of the contract will be more than the total contract price. So we try to total them. This one, this gives a positive figure. And if we take it on like that, okay, this 25, this 25, this 25, this 25, this 25. Let me check the information we picked. Estimated cost to complete, cost incurred the date, cost to complete 1.4. Yeah. This 25. Okay, I picked 25,000. I think it's 2.5 million. Let me check the question again. Sorry, it is 2.5 million, not 25. So it should have been 2,500. There's a figure. These figures are not right. So it should be 2500. Since I'm rounding it, 2500. 2500. So it's 2500. So we can now see there's one onerous contract here, which is contract, the middle one, contract Y. You can see there's an onerous contract here. So what do we do with this loss? What do we do with this loss? That is what we're supposed to be treating now. So the future loss on the contract, for contract Z, we have 200,000 times what is the percentage remaining to complete the contract. As at this day, we discover the loss. Let's look at it. So it's been performed 35% in the past. So we want to recognize this future. The total loss to date is what? The total loss on the contract is 200,000. But what is the future loss? Future loss is the remaining percentage to complete multiplied by the loss we discovered to date. Please get it. The future loss what? The remaining percentage to complete. We have done 35%. We are supposed to go 100%. So we have 65% remaining. 65% times the loss we have measured now is the future loss. So percentage to complete. Percentage to complete the contract is what? 65%, because it's going to be what? 100 minus 35, which is the percentage done to date. And that will give us what? 65%. 65%. So the future loss, therefore, the total loss, this is total loss. Total loss Then the future loss. The future loss will be the multiplication of this and this. So it's going to be equal to 200 times 65%. And so our future loss on the contract that we are measuring assets today is 130,000 in respect of contract Y only. Is the only one that is an onerous contract. The future cost to date plus cost to complete is higher than the contract price. So 135,000 naira. We are done with that step. So let's go to the next step. Step 3 says calculate the revenue to date. What's the revenue to date? Contract price times percentage of completion to date. So let's come here. Revenue to date. Number 3. Revenue to date. Revenue to date. And to calculate revenue to date, we say contract price, which is how much? Contract price, we already have it here. This is contract price in respect of the three contracts. Don't forget, I'm just using the column. I don't want to be writing X here, Y here again. I've done this at the heading. So each transaction will be falling under each contract. You know what we do? And percentage of completion. Percentage of completion. Percentage of completion. Percentage of completion. We have done that here. So just copy it here and come and put it here. Percentage of completion. Therefore, revenue to date will be what? Multiply this by this. So equals this total price times the percentage of completion, and then we have revenue to date. And if I just drag it like this, the same thing will be done for each of them. So this is just this multiplied by this gives us this. This multiplied by this gives us this. That is revenue to date. So I'll mark it here. So we go to step 4. It is important for us to know how we are moving step by step. Sir, yes. Thank you very much. I later discovered it is 2.5 million. Thank you. So, step 4. So calculate the cost incurred to date. That is, add cost incurred to date to cost to complete the contract and multiply with the percentage to complete the contract. Can you see? Cost incurred to date, that is cost incurred to date. We are going to add cost incurred to date to cost to complete, and we are multiplying it by percentage to complete. So that is cost, that's step 4, cost incurred to date. So cost incurred to date. So let me, step 4. Cost incurred to date. That is, calculate cost incurred to date. That is cost incurred to date plus cost to complete the contract times the percentage of completion. That's what we are trying to do now. So we say cost incurred to date. Cost incurred to date. We have that information here. That is it. Just take the negative out of it. Cost incurred to date. Cost to complete the contract. We have it here. So let me just copy that also. Cost to complete the contract. Cost to complete the contract is here. Information is here. Cost to complete the contract is here. So let me just take the negative signs away from them. Supposed to just multiply them by minus 1. Okay, let me just take time to quickly do that one by one. What we are trying to do is now to determine the cost of this contract based on the percentage of completion, not based on the actual amount of cost that the company has incurred. Because if we want to actually measure cost, it will be based on the total cost times percentage of completion, which is what we already have here, percentage of completion. Total cost times percentage of completion. So this is cost incurred to date. This is total cost of the contract. And then we have percentage of completion. So we are going to be having our cost incurred to date, which we are going to be measuring, will now be what? Cost incurred to date will what? This times this. So we say equals 2.1 times, here, 70%. And so that is it. So it agrees with this one. We are testing. If it does not agree, whatever we get here is going to be the cost we are going to be measuring. But it agrees. You can see it agrees, meaning that the percentage of completion agrees with the measurement of cost incurred to date. We're just doing that as a test. So next, number 5. Step 5. Step 5. What does step 5 say? Step 5 says, calculate the revenue to be recognized in the financial statement. And how do we do that? Revenue to date, less any previously recognized revenue. Don't forget in the question, they said in the statement of profit or loss for the period ended 30th June 2022 includes revenue and cost of 650,000 and 550,000 respectively in respect of contract X. So let's do that. The information we are going to calculate revenue to recognize financial. So revenue to be recognized. Revenue to be recognized will now be what? The revenue to date, which is what we have here already. I've calculated it. Revenue to date. Revenue to date minus previously recognized revenue. Previously recognized revenue. What is that? It's only in contract X that we have that. There's nothing in contract Y. And how much do we have previously recognized revenue in contract X? Contract X, according to the question, has recognized 650,000 because they said respectively. So revenue is 650, cost is 550. So 650,000 is the revenue that is recognized previously under contract X. Don't forget this first column is what is for contract X. So here I'm having this put here. Let me reduce the font. It's going to be 650,000 since we have rounded it up. Let me use the same font with this one for it. And for here, there's no revenue recognized previously. Here, no revenue recognized previously. We only have that only in respect of contract X. So, So we have the total here. That is the revenue to be recognized in the financial statement. Revenue to be recognized in the financial statement. Revenue to be recognized in the financial statement in respect of this contract. Don't forget, we are supposed to prepare the statement of profit or loss and the statement of financial position. So this is the revenue we are taking to the statement of profit or loss. Step 6. What does step 6 say? Step 6, based on the guidance, is calculate the cost of sales to be incurred included in the financial statement. That is cost incurred to date plus any computed future loss minus any previously recognized cost. And you see, so cost to be included in the financial statement. Cost of sales. We call it cost of sales. So I call it cost of sales. And so to calculate cost of sales based on what we are doing now is going to be what? Cost incurred to date. That is, you can see the guidance here. Since calculate is what? Cost incurred to date plus any computed future loss minus any previously recognized cost. So what is the cost incurred to date in respect of this contract? We have done the calculation here. Cost incurred to date. So I just pick it. I put it here. Cost incurred to date. We have it here. So future loss. What is the future loss? There's only one transaction, but one contract that has future loss, which we have done here, and it is only contract Y based on the expected future loss 130,000. So I just come here and put it under contract Y. It's the only one that has future loss. So let me just link it there, 130,000. And these ones don't have future loss, so it will be zero. This one will be zero. Then less any previously recognized cost. Don't forget, in the question we have that for Y, you can see here for Y, so for contract Z, you say revenue and cost. So this is for revenue, and this is cost that has been recognized in the last year, 20x2. We are working on 20x3 financial statement, and in 20x2, they have recognized this in respect of contract X alone. So the cost is 550. So we are going to be deducting that from it. 550 only on contract X, 550, 550. It's going to be negative, no previously recognized cost here, and no previously recognized cost here. So let me just put this in bracket. So I'll put them in Naira value now. So that is it. So we are going to be having this summed up, and as we sum them up, this is going to be what cost of sales recognized in the financial statement. This is going to be the cost of sales. This is going to be the revenue. You can see we are just, when we are doing the financial statement now, we'll just be picking the figures and putting them there. So the next guidance on this step is what? Number 6, calculate the cost of sales. Okay, we have done that. Number 7, calculate the contract asset or liability. Cost till date plus profit till date minus total loss on any onerous contract less any amount invoiced to customer. That's how to calculate contract asset. So contract asset, number 7, contract asset or liability. Because we don't know whether it's an asset or liability. Contract asset or liability. Contract asset or liability. And what is the formula for computing it? The first thing we are supposed to pick here is what? Cost till date. So the first transaction that we are going to copy is cost till date, which is what? The information we have in this place. Copy it, we put it here, cost till date. Then what does the second one say? It said cost till date plus any computed future loss. What is the computed future? Okay, sorry, this is it. Cost till date plus cost till date minus total loss. So cost till date plus profit till date. What is the profit till date? We will compute it here now. Profit till date. Profit till date. Profit till date. The profit till date is going to be what? The total revenue till date. Don't forget, revenue of this was recognized in period. So first we will pick revenue till date. This is it, revenue till date. Minus cost till date. Revenue till date minus cost till date will give us what? Profit till date. So I'm going to be picking the figure here equals to what's revenue till date? 1,750 here minus what's cost till date? 1,470. I got for this one. If I move like this, Excel will also calculate the rest for me. You can see revenue till date, that is this one is what? 875 minus 975. This one is what? 1,000. To calculate this, 1,000 revenue to date minus cost to date, 800,000. Can you see? Then the next transactions there says what? Cost to date plus profit to date minus total loss on any onerous contract. So total loss on any onerous contract, total loss on onerous contract. The only onerous contract in this place is what? This. What is the total loss? So this one is 0. This one is 0. The total loss on it we calculated is what? Is 200,000. The future loss is 135, 130, the total loss is 200,000. So total loss is going to be what? Equals to, then we put this here. Can you see? That is it. Check the formula again. Cost to date plus profit to date minus total loss to date. So we are going to be deducting this total loss from it. This total loss from it. Oh, it should be future loss, not total loss. It should be future loss. Sorry, be future loss, so that we don't have a future loss, future loss on the onerous contract, and so we are going to be having the 130 here, so that we don't have double negative. It's going to be minus 130, so that eventually the loss will show to agree to be the same thing. So we are now going to be having this, and what's the next transaction there? Less any amount invoiced to customer. Less any amount invoiced to customer. Based on the question, the invoice is what? They give us amount invoiced to customer. You can see it here. Amount invoiced to customer. So we are calculating contract asset now. Let me copy this one here. Amount invoiced to customer. So amount invoiced. So please, you watch this video again and see how we moved one step after the other. This is going to be about the most technical question that you will encounter on IFRS 15. The first might be for you to calculate the percentage of completion, either using the input method or output method. Another task might be how to calculate the contract asset, which is usually one of the most technical parts of any question. So we're having this here. Let me just put everything in Naira form and take the nearest whole number. So the total of these is what we are going to be having. If it is negative, then what we have is liability. If it is positive, what we have is an asset. You can see we have contract liability in respect of X and Z, and we have contract asset in respect of Y and Z is liability, while the other two are what? Are asset. While this only one is an asset. You can see if it is negative, it's liability. If it is positive, is what? An asset. You can see total contract price is 1 million naira, but you have invoiced how much? 150. No, sorry, revenue to date is 1 million naira, but you have invoiced how much? 1,050,000. So you have liability in your hand. Revenue to date here is 875, but you have invoiced 900,000. So you have 155,000 naira. You can see that's it as liability. So what that seems to be the last thing that we're going to be doing. So okay, now step 8, calculate trade receivable. The difference is what? Amount invoiced less any cash received. So let's do trade receivable here. Step 8 is going to be what? Trade receivable. Trade receivable. I'm checking if there's any comment. Okay, I hope you are still with me, everybody. So trade receivable. Trade receivable. The difference, trade receivable was amount invoiced, which is given to us here. Amount invoiced, this amount, just that it has to be positive figure here. Amount invoiced, that is how much we have asked the customer to pay, and the difference between it and how much the customer has paid will be trade receivable. Amount invoiced. I'm checking. Okay, amount invoiced, and then the difference between amount invoiced and what? Less cash received. How much is the cash received? Is here. Cash received is here. This is the amount of cash that has been received. That is this amount. You can see. So let me just lift it out and then put it here. This is the cash received. Cash received. cash received. I'll need to put them in jacket so that we have, cash received, negative. You know, it is logical. How much you ask customers to pay is the invoice you send to him. How much he has paid is the amount. So cash received. So what we are going to be having now is trade receivable, and which is what the difference between these two. The difference between these two is trade receivable. And so we move it like that. Myself need to calculate it faster. And so that is it. So we have trade receivable in respect of contract X and Y. No receivable in contract of in respect of contract Z. We have contract asset under contract X. There is contract liability for X and Y. Cost of sales is here, and this is here. So we have to prepare the financial statement extra. That's even the requirement. Everything we have done is workings. The requirement is that show how each contract will be reflected in the statement of financial position first. So let's answer question A now. Question A. All these are workings. We just label them. So we come here, let's say that's this example 2 continue, so that we have I want to put it here, example 2 continue. Example 2 continue. So that if you are studying it, you know exactly what you're doing. So A, we are answering a requirement A here, which is what? Statement of financial position. Statement of financial position. Statement of financial position as at 30th June. I think it's 20x3 or so, 20x3. So you know the name of the company is Prince PLC. Just the custom, we need to also master this. It's important in examination. Prince PLC. That's the name of the company. So we put this there. So we are going to be having, let me have the Naira sign somewhere here. So contract asset and trade receivable are current assets. So we don't have anything under current, non-current asset, non-current assets. Nothing is going to be there. We don't have information to that because it's a financial statement extra. So current assets. So we have contract assets, and it's only okay. Sorry, I need to put the contract. Let me create a space. I need to put this contract X, contract X, contract Y, and contract Z. So let me just try to create more space for them so that they will show very well. So for contract asset, the only item that has contract asset here is what? Is contract X. So I'm just going to be linking the figure there. So usually we are still coming to that. There is a way to present your financial statement. I will still be teaching you on presentation of financial statement. This middle is supposed to be notes. Don't worry, I will be doing that. Even what I'll be giving you for presentation is going to be the standard we use in practice in a firm. So contract asset is note what? Which is, I know the sentence as working. Where is contract asset? Contract is note 7, and the figure is going to be 600 only for X. So let me link it first. I link it here. Contract assets is 600,000, and so it's under what? Note 7. Note 7, I put 7 there. That note is what you normally say and say they will say workings. You can call it note, you can call it working. And this is 0, This is 0. No contract asset in respect of the rest except for X. Then trade receivable. Trade receivable under current asset 2. What is the note of trade receivable? Trade receivable is just 1 minute, please. 1 minute. Trade receivable. Just 1 minute. I'm trying to plug my devices. Well, so I'm back there. Trade receivable is note 8. Trade receivable is note 8. So I'll take the note there first. We'll learn presenting of financial statement and then the group account. When we do it together, you see how we do it. So, and what is trade receivable? Which asset has trade receivable? X and Y have trade receivable. So I'm going to be linking it there. Equals trade receivable here. And then for Y, it also has trade receivable, which is here. 0 for Z. Trade receivable is 0 for Z. You can see how I'm doing it. So total current asset is the addition of these two. Total current asset is the addition of these two. That is on current asset. Then there is current liability. There is current liability. And under current liability, you know, asset and liability will be up. Then we have equity and liability. Let me just put it there. Equity and liabilities. That's what the segment is called. When we do presentation of financial, you will see now you should do it. And so we are supposed to have equity information first, and then we'll have, so let me have equity information will be here. Then we're going to be having current liabilities somewhere here. Let me say current liabilities. And the only current liability we have in respect of this transaction is what? Is contract liability. Contract liability. And what is the note? It's still the same thing as contract asset or liability. Don't forget this note is for contract asset or liability. So contract liability is also note 7. Note 7. And which transactions have contract liability? Only Y and Z. Y has 150. X has 0. Y has 150. 155, sorry. And then Z also has 50. That's it. These are the informations that will affect the statement of financial position as far as this transaction is concerned. These are the only information that will affect the statement of financial position. That is contract asset, trade receivable, and contract liabilities. They are the things that will be posted where in the statement of financial position in respect of this transaction. Sorry, I shouldn't have put it like that. Let me just take the borders away. This is how it is presented. Don't worry, I'll be teaching you presentation of financial statement proper. You know how to do it. So our B, let's answer question B. Question B. What does question B say? Sorry. Okay. I'm just trying to check up if there's anybody asking any question. Let me see how many of us are still here. Just 2. Okay, Mr. David and I think Juliet is offline. Many people prefer to fall back on the video. They can't wake up. They used to tell me that they watch the video after. No problem. So, statement of profit or loss. Statement of profit or loss and other comprehensive income. That's the title. For the year ended. Oh, I wasn't putting the title. Sorry, I'm supposed to use a statement of profit or loss and other comprehensive income for the year ended 30th June 2023. The year ended 30th June 2023. So that's it. So we're still going to be having the headings, the naira, okay. I'll need to copy the note also. Like that, put it here. We have it here, contract S, contract Y, contract Z. And so we are having the first thing recognized as revenue. As usual, don't forget revenue. And what's our revenue? What note is our revenue? Revenue to be recognized in the financial statement is note 5. So we'll come in and say 5, note 5. And so what is the revenue to be recognized in respect of this? This is it. These are the revenues that are going to be recognized in the financial statement. Just move the figure here. See, when you have done your workings, presenting financial statement becomes easy. You just be picking your figure. Just be picking your figure and putting your figure there. That's why it is the workings that is actually important. And during presentation of financial statement, I'll be teaching you the strategy, how that you have to do a pro forma financial statement first, and then be inputting the figures necessary. Then next will be cost of sales. Cost of sales. Cost of sales. And the cost of sales to be recognized is what? Is these two. Just that it's going to be in negative. Cost of sales to be recognized is here. And so I'm just going to be putting it. Cost of sales to be recognized is here. So let me just okay. Sorry, what's this one coming here? This will be negative. This will be negative. This will be negative. So we are now going to be having our gross profit. You know how we do it. Gross profit. That is it. That is all that will appear in this financial statement in respect of this transaction. This is what will appear in the statement of profit or loss in respect of this transaction. You can see what we have done, and we have done it the way we should have done it. So here we have our statement of profit or loss. Let me just try to count it. And here we have our statement of financial position in respect of this transaction. I'll also count it here so that it is easier for you to study them on your own. That is it. We have been able to answer this question. The notes to the account is done on a separate place with each number carried out. So what you need to actually master, what you need to actually master is how to treat these issues. So this is important. When I put these notes in the chat box, I want you to go through this procedure anytime you are tested on contract in the examination, how you should be treating it one by one. Determine whether there is an onerous contract before you move on. Onerous contract is a contract that is future cost. The total cost to complete the contract is higher than the total contract price, and the amount to be treated as a cost, as part of the cost of sales, is what the future cost from today that we are measuring. And we have done that in determining what is the cost of sales here. You'll see how that we have been able to move here, and then recognizing cost incurred to date, less any previously recorded, then plus the future loss. You can see less any previously recognized cost, and we have been able to. That's how we arrive at this figure, the figures in this place. So we move on to the next task. If you have question on that, you can send it in later. One strategy of this is that we can just continue to move on and then see how much we can cover. course, we have a lot to do, but I hope God will help us. But that's why the class is open 24/7. Watch the video anytime. Whenever you have time to study, sit down with the video, watch it again, treat past questions, raise questions for me, put it in the chat box, even when the class is not in session. And then I will work on it at my free time. If it is something we will treat in class, I will treat it. If it's not, I can do it at my private time and do a voice note and put it there in the group chat. Please, I want us to take our study more seriously. So, significant finance component. There are instances where customers may pay for goods or services in arrears or in advance. When the customer pays for the goods and services in arrears, it means that the entity is effectively providing financing to the customer. That is, when they pay in arrears, you have done the service, they are now paying. They are now paying later after you have done the service. Likewise, when the customer pays for goods and services in advance, the entity has effectively received financing from the customer. IFRS 15 requires a financing component should be accounted for only when the financing component is significant. If it is insignificant, there's no need for us to be computing it. Please, are we to prepare all steps in examination or only information needed? If you are, depending on the question they ask you, look at the requirement. If they ask you, it may not test every part. But if they present a question like this and you are to prepare a financial statement and include information regarding the contract in it, you need to know the percentage of completion. Very important. They would have given you cost incurred to date, or they can give you the total cost and use the percentage of completion to multiply the total cost. It is of course it is based on what they ask you in examination. But if the question is to test everything on IFRS, make sure you know how to calculate your revenue, which will be recognized in financial statement. Make sure how to calculate your cost of sales, which will take you through all these procedures, and test for onerous contracts and know how to treat it. Very, very important. Onerous contract, you must test for it. They will just include it somewhere. Onerous contract, total cost incurred to date plus cost to complete, you take it out of the total contract price. If the cost is higher than the price, then you know the total cost, total loss on that contract, and the future loss from the date of the contract is a percentage you have not performed. Multiplied by the total loss, that is the amount that will be included in the cost of sales. So you may necessarily do all the steps and you may not necessarily do all the steps, but if you have to calculate revenue on the contract, you have to calculate cost of sales, you have to determine contract liability, contract asset. It may be necessary for you to do all those steps if tested. So that I believe that answers that your question, Mr. David. So now we move on. IFRS 15 requires that financing components should be accounted for when the financing component is significant. Financing component is considered significant if there is a significant difference between when the control over goods and services are transferred to customers and when settlement or payment is made by a customer in respect of the goods and services transferred. If there is a lot of gap, I need to supply you something in December, you have paid me in January, that's going to be significant financing difference. If I receive the money in advance, because of the time value of money, I'm not supposed to treat that money as my income. There's an element of it that should be treated as what a financing component that I've enjoyed from the customers. So I'm going to be calculating the difference between the time value of money between January to December. And if I've done the job for you in January, you are paying me in December, there's a significant financing component there. It means I'm giving you a financing. There has to be an interest expense that I'm going to recognize in the financial statement because the money you eventually pay me has lost value. So there's going to be interest income and interest expense when the gap between the time you receive money and the time you deliver the goods is significant. When the financing component is significant, the contract price or the promised amount of consideration will no longer be the transaction price. You can see, according to IFRS 15, the contract price or the promised amount of consideration should be adjusted for the effect of time value of money in order to derive the transaction price. That is, the financing component should be excluded from the contract price or the promised amount of consideration in order to derive the transaction price. Let me see if there's an example. If we have an example on this. So we talk about financing component will be considered significant if all of the following exist. Conditions that will make you to consider it significant. The difference, if any, between the contract price or amount of promised consideration and the cash selling price or the promised goods or services is what significant. If the difference, by the time you do the time value of money, the difference between the money is significant. For instance, the interest rate in the market determined by the central bank is 10%. I've done job worth 1 million for you in January, but you are giving me the 1 million in December. So I have to discount the 1 million naira to the time that I've actually done the job for you. It means you paid me 900,000 naira. The other 100,000 naira is an interest expense. I can't recognize that as an income. I mean that I've incurred that as an expense because you paid me late. So if the 1 million naira goes to revenue, I must recognize interest expense of 100,000 as well, so that eventually my revenue will be 900,000. Please, it's very, very important for us to take that into consideration. B, the expected length of time between the entity's transfer control, between when the entity transfer control over the promised goods or services to the customer and when the customer pays for those goods or services is significant. Time is the significance, the difference between the money is significant, so we need to do financing component. However, the financing component will not be considered significant if any of the following factors exist. One, the customer paid for the goods or services in advance, and the timing of the transfer of those goods or services is at the discretion of the customer. That is, you are not the one who determines when the goods will go to the customer. He has paid in advance, fine. You have done the job, he paid you in advance, but he's the one that has not come to pick his items. He's the one that has not responded to come and pick his goods. It is not your own responsibility. So it is not, sorry, you are not the one delaying. So there is no need to recognize financing component. B, a substantial amount of the consideration promised by the customer a substantial amount of the consideration promised by the customer is variable, and the amount or timing of that consideration varies on the basis of the occurrence or non-occurrence of future event that is not substantially within the control of the customer or the entity. That is, this is just like contract discharge over time. That is, there is variable in the time, and you are not the one determining the time, and the customer is not determining the time. Maybe circumstances. For instance, I want to buy pairs of shoe. You paid me. I want to do a pair of shoe for you. You are my customer at the company. You have paid me in advance, but the two of us agree that to buy the leather you need for this your shoe, they have not opened border, or the leather is not in the market. That's the reason for the delay. It's not in your power to control the time. It's not in the customer's power to control the time. There's no need for recognizing financing component. The third one, it said the difference between the promised consideration and the cash selling price of the goods or services occurred because of reasons other than the provision of finance to either the customers or the entity. That is, the time, the difference between the money occurred not because there is no money, but because other factors were responsible. So we talk about interest rate implicit in the contract when we are measuring the financing component. The interest rate implicit in the contract. This should be the discount at the inception of the contract, and will usually be the incremental borrowing rate of the seller or the prevailing market rate. If you want to calculate interest, it's either you use the borrowing rate of the seller, which is the company, or the prevailing rate in the market. Please, we need to understand that monetary policy is controlled by the monetary authority, which is the central bank, and they are the ones who determine the discount rate. Don't forget, we learned that in economics, talking about instruments of monetary policy. Discount rate is there. Central bank is the one determining discount rate. Discount rate is the rate at which loan should be given by banks. That becomes what? The market rate, the prevailing market rate that we are talking about here. The prevailing market rate is the discount rate in the market, and that is what the rate at which bank will give out loan. Example, we have Shaggy PLC. On January 1, 20X5, Shaggy PLC sold and delivered a product on credit. You can see on credit to R. Kelly for 726,000. Let me also put this in Naira. 726,000 Naira. It was agreed that R. Kelly is to make the settlement on 1st January 20X7. Look at it. He delivered a product on credit. He has done the product. The company, Shaggy PLC, has done the product as at 1st January 20X5. Shaggy PLC sold and delivered a product on credit to R. Kelly for this amount as at that day. The agreement between the two of them is that settlement will be made in January 20X7. You can see the time is there's a gap, 2 years gap between the supply and receiving of money. The cash selling price of the product is what? 600,000 Naira on 1st January 20X5, which represents the amount that is payable by R. Kelly for the product upon delivery. That's supposed to be the price. But because of this timing difference, the price is 726. We need to separate the interest element from this transaction. So, where are we? Shaggy PLC would have needed to borrow funds at an interest rate of 10%. Shaggy PLC prepares account as a 31st December of every year. Required, determine the cash selling price of the product. B, determine the financing component, if any. Number 3, explain how the above transaction should be accounted for in the book of Shaggy PLC. So please let's quickly treat that example as well on financing component. Let me try and put everything we have done in this place in a frame for us to know it's part of example 2. Everything we have done under that example. Let me put it in a frame so that we know it is example 2. Example 2 is part of what we did, and the continuation of example 2 is here too. It's here. So I think I need to also put that here so that you know that everything is the same thing. So if you want to study it, this is the workings for example 2. This is the presentation of financial statement for example 2. So I go to example 3 now. Example 3. Example 3. Example 3. Sorry. Example 3. Talking about financing component. Financing component. Financing component. Example 3, the financing component. So now let's look at the question again. The transaction took place as at 1st January 20. So on the date of this transaction, there are journals that must be passed by this entity. The journals will be in respect of revenue, that because the performance obligation has been done as at this date. You have done your part, you need to recognize revenue. But at how much are you going to be recognizing your revenue? Because the agreement is that this man will pay you this amount. This is the amount of receivable. This is the amount of receivable that this man is supposed to pay. You need to debit receivable and credit your revenue as at that day. And you need to know how to treat the remainder part. So we'll do about revenue recognition on 1st January 20X5. That's the first thing we want to do. Revenue recognition on 1st January 20X5. So revenue recognition on 1 January 20X5. So the journal, so the double entries, what I want to do here, debit, credit, debit, credit. Since both of you have agreed that he is going to be paying, how much? That he's going to be paying this amount. That becomes the amount of receivable. So the journal will be what? Debit, trade receivable. Trade receivable. With the total amount we are expecting to receive from him. Okay, let me shift this on so that I can put the arrow sign here. So debit trade receivable with how much? How much is he expected to pay? 726,000. 726,000. 726,000. Credit revenue with the amount of transaction price. Revenue, credit revenue. Credit revenue with the amount of transaction price, 600,000. That's the amount that will go to trading profit or loss as at that year, and we are going to be crediting interest that we are expecting, the financing component that we are expecting to receive from this customer. Trade receivable is this amount, and then revenue is this amount. Then the difference between the revenue and trade receivable is minus this. Receivable. This is a credit transaction for us to have a balanced journal. I'm trying to, sorry, just 1 minute. Credit receivable, the amount we are expecting to receive from the customer. Then we credit our deferred income. Yes, deferred interest income. Yes, interest income. Why is it deferred? We have not received it, but we are entitled to it. It's an income. Deferred income, don't forget, is a liability account. It's an income that we are entitled to. We have recognized it, but we have not earned it. It is the passage of time that will make us to recognize this. And we will now be seeing how it is recognized now. So at the end of this is as of January 1st, 20X5. Don't forget the date of that transaction. That's what we just did now. That's the first journal that will enter the financial statement as at that date. Then at the end of that year, which is what now? 31st December 20X5. When you are preparing the financial statement, you need to now calculate how much of this you need to recognize. They have told us in the question that the prevailing interest rate is what? 10%. So the interest income, that the interest that will be recognized as a receivable, which will not be part of your income, you have recognized, which will be your interest income. As at the end of the first year, is going to be the 10% of the total transaction price. So let's do it here now. So transaction price is how much? 600,000 naira. Interest rate in the market, interest rate is how much? Based on the question, interest rate is 10%. 10%. Therefore, interest earned as at the end of the first year, interest earned as at the end of first year is going to be 10% of total. So we are going to multiply these two together. It will be equals to 600,000 times 10%. That is the interest earned as at the end of the year. Do we get it? That is the interest earned as at the end of year 1. And what is going to be the journal for this interest earned? We will debit deferred interest income and credit interest income. So the journal will be here. Let me just copy this heading here. The journal will be as at the end of year 1, which is the first year, 20x5. So it's going to be what? Debit deferred income. Deferred income will be debited. Deferred income. Deferred income. Interest income. Will be debited with how much? The amount of interest, which is what? 60,000 naira, and we will credit interest income with how much? 60,000 naira. So it means that when we are preparing the financial statement for 20x5, the figures that will go to financial statement is going to be the amount of transaction price, which is revenue, plus the interest earned, will go to the financial statement. For year 2, as at the end of, that is 31st December 20x, what is that going to be? 20x6. Let me look at it. 20x5, 20x6. Okay, yes. 31st December 20x6, or we call it 1st January 20x7. They are the same day. Don't forget, 31st December 20x6 and 1st January 20x7 are the same date, because the information you have as at 31st is what you are opening with on the 1st. So it's the same day as this date. So 31st December 20x6, when you are preparing the financial statement, what is going to be your journal? Now, before the journal, we need to do a computation. As at that date, the transaction price, the total amount accumulated in the previous year, which we recognize, is 600 plus 60,000 naira. So, let me have this here, please. So, we are going to get the transaction price. Transaction price is 600,000 naira. Don't forget. Then the interest earned in the previous year, interest earned last year is what? 60,000. You see? The total of the two will give us what? 660,000 naira. Then the interest in the current year is going to be the rate of interest. Interest rate in the current year, interest rate is still 10%, according to the question. 10%. So the interest that will be earned in the second year, what is going to be the interest earned in the second year? Interest earned in year 2 is going to be the multiplication. We multiply this by this, so it's going to be what? 660 times 10%, which is what? 66,000. That is the interest earned in year 2. And what's going to be the double entry also? The double entry is going to be what? Debit. So we debit our deferred income, that is deferred interest income, just the same journal we passed in this place. The same journal we passed. Where did we pass the journal here now? The same journal we passed here. I thought we passed journal for year 1. For year 1, debit. Okay, this is it. The same journal we passed here. The same journal we passed here. That is debit interest income with how much? This amount, 66,000. Credit debit divided income with 60,000, and credit interest income with what? 66,000. Being interest in year 2, being the interest for year 2. Then this one, the first journal here would be what? Let me just total it, please. It's very important for good presentation. For good presentation, let me total it. And this one too, for good presentation, let me total it. For good presentation. So it's going to be being interest in year 1, being interest in year 1. Now, what have we done so far? We have a receivable of 726 at the beginning of the year. Our first financial statement recognizes the revenue of 620 and interest income of 60,000 naira. Our second financial statement recognizes only the interest income of 60,000. And so what have we done? The initial 126,000 that we credited to deferred income, we debited it in the first year with 60,000, remaining how much? If we say 66 minus 60. Because I want to, okay, maybe I should complete the journal for each year so that we can be able to see. This is journal in respect of, so deferred income had an opening balance as at this date. Let me do another journal here for deferred income so that we'll be able to see. Deferred income had an opening balance of how much as at this date, the amount we credited it to it, 126. It has an opening balance of 126. 126. And now when we debit a liability account, what we do is to reduce it. So when we debit it with 60,000, we reduce the balance to how much? The difference, the closing balance on deferred income will be what? 66,000. And that is the amount we debit it with also in year 2. In year 2. So let me do this one. This is the deferred income account. In year 2, we debit it also with 66,000. Debit liability is a negative, and so deferred income will now be 0 at the end of year 2, because we deduct this from this, and then we have 0. And so our receivable account, what has happened to it? Because we initially debited our receivable account with certain amount of money. With certain amount of money, we have recognized 600 in revenue. When this money is received, so trade receivable now, let me put trade receivable here. Trade receivable. There's an opening balance of how much on trade receivable. When we open the balance, we have we debited it with how much? Total amount 726. 726. So revenue has taken how much from me? Trade receivable opening balance, balance BF, balance BF. So revenue has taken how much from it? Revenue has taken 600,000 out of it. That 600,000 of it is revenue. 600,000 is revenue. Because when you credit revenue and debit trade receivable, that's the 2 leg. And interest in year 1. Interest in year 1 is 60,000 naira, which we recognized here. Abi? Interest in year 2. Interest in year 2 is 66,000 naira, which is what we recognized here. So our trade receivable account is also new. We have been able to allocate our trade receivable account, but don't forget that what we will do is that this amount will remain in trade receivable until it is paid, when the money is paid, so when the money is received, when the money is received, what do we do? The journal will be double entry DR, CR. The double entry will be debit bank, which has received the money, bank, with the amount that the customer will be paying, which is the total amount we expect him to pay at the end of that period, the 2 years, and credit trade receivable. Trade receivable. Credit it with the same amount to close the trade receivable account. But what I did here is trade receivable allocation. Allocation receivable. Allocation. What made up that figure in trade receivable? So you can see this is journal. So being the receipt, being the receipt of money, being the money received from the customer, because he will be paying as at that date, he will be paying the money is owing as at this day, and that is how the journal will be passed. So the first year, 10% of the contract price. Second year, 10% of the total of the accumulated money is still owing, which is the contract price plus the interest for first year, and then we arrive at that. That's how we calculate it. So this one should have been coming. This one should have been. I need to name this one. Let me move it down. This is our deferred income account. Yes, deferred income account. The deferred income account. Let me put it here. Deferred income account. So deferred income, interest income, deferred interest income. So it has a balance brought forward of this, balance BF of this. Then this allocation in year one, that is the one that when it is debited, interest for year one, interest for year one, coming interest for year one, and then interest for year two, interest for year two, and then it comes to zero. That is going to be what we'll be doing in this transaction. So if we are to do financial statement extra, year one revenue will be 60,000, interest income, which is other income, will be 60,000. Or maybe I should quickly do that here. I know time is not on our side. Maybe many of us have even left me in the class. I don't know. But anyway, you know you are covered. The video is recorded. Mr. Tosin, you are also welcome. I'll see you there now. So let's quickly do financial statement extract. Financial statement extract. So statement of profit or loss extract. Statement of profit or loss extract. Statement of profit or loss extract. So we are going to be having, let me just use this as an arrow sign. We have it here. This is as at, so I'll just put the date there. This is what 20x5, which is the year that the transaction took place, 20x5, and this is going to be 20x6, which is year 2. Or if I want to do it, we do the financial statement for 20. So we do 20x5 January 1st, then 20x5, 20x6. This is January 1st also. Let's do January 1st, 20x6, January 1st, x6, and 20x7, which is January 1st also. We are also as at January 1st is this account I'm preparing. 20x7. So let me say this statement of profit or loss extract for the period 1st January. Let me just put it there. Although they have told us that the account is prepared at the end of the period, but for us to have a seamless financial statement, So for profit or loss, it is at the end of the year that the financial statement is presented. So on the 1st January 20X7, there is nothing in the account. So revenue as at this date will be nil, because the financial statement is prepared at the end of the year. So it's going to be 0. Whilst at this place is what? 1st January, we have revenue of 600,000 naira recognized. And then we have other income. And we have interest income. Under other income, we have our interest income. And that interest income is also not, we are going to be putting figure when we get to the balance sheet as at this date. But let's leave as at the end of 20X6, we have interest income of what? Of 60,000 naira. I'm sure you remember. So this is going to be what, and for 20X7, we are not going to be repeating recognition of revenue, but we are going to be recognizing the interest income for 20X6 as at the beginning of 20X7, which is the second year interest income. I'm sure you still remember. And so this is going to be the face of the financial statement in respect of this transaction. As far as this transaction is concerned, the total here is 0, and then we can have the total for each year like that presented for revenue. So for the balance sheet, statement of profit or loss, statement of profit or loss. So for 2005, 2006, you can see the opening balances and closing balances. Because of this financial measure, I even put the 3 years, should have been 2 years. So the opening balance on receivable as at this date, the opening balance on receivable, so under current asset, let me just say non-current asset, so that we know what we are actually presenting. Then we move on to current asset, non-current asset, then we go to current asset. So as at January 1st, trade receivable. As at January 1st, the trade receivable is going to be how much? The total amount we put inside it, which is opening balance of trade receivable, 726. So it will continue to be 726 until when the money is paid. So if the money is eventually paid this year, it will be 0, and bank will have the 726 when we receive the money. Then deferred income, the income we have recognized but have not earned under current liability. Current liability, deferred income under current liability is the interest we earn in first year. So it has opening balance. It has opening balance of 126. Don't forget we recognized it at the beginning of what? 126. It has opening balance of 126, and then current liability is not going to be 126. It's going to be the amount receivable in 1 year time. Don't forget the balance sheet. Current liability, so it's the 66,000 naira that will appear as current. The 60,000 naira that will appear as current liability in the first year, and the non-current liability, non-current liability, we have deferred income also. Deferred income, but the amount is the one that is beyond 1 year. It's going to be that 66,000 naira. 66,000 naira deferred income. So current liability in the following year, at the end of the first, that's the opening balances. So the total liability in first year will be the addition of the two, 126.
But now at the end of the first year, which is the second year, we are now going to be having only this amount as current liability, no non-current liability, because it is receivable in 1 year, and that also will be here as the total for year 1. And for this place, there is no longer liability, there is no longer liability, because everything would have been paid as at this date. So that is how the financial statement will look like for this transaction. Receivable, we have this, and the movement will be between receivable and bank, and then no non-current liability, no non-current liability, no current asset. No non-current liability, no current asset, just like that, and then we total this one too. You can total this as for the current asset the first year, like this. Total the same thing here. And then here we have the same thing put there, just to have the presentation properly done. So you have seen what we have done: profit or loss, extract as at that date. Statement of profit or loss. Second is statement of financial position. So what did I write? Statement of financial position. Financial position. Statement of financial position. So that's how it's going to be. So that will be all for today. Tomorrow, by God's grace, we will complete this standard. There are two widest standard. The third one is IFRS 9, IS 16, IFRS 15. They are wide in scope. So we will need 3 classes for each of them. That's what we did for IS 16 too. So the third one that is wide is IFRS 9, financial instruments. It also will take 3 classes. The rest will not take as much time as we expect, and then we'll be done, be able to cover the entire syllabus by God's grace. When make sure you do that before the exam approaches. So I believe please, the second title should be statement of financial position. Yes, I just read your system. I've seen it. That's a mistake. I've corrected it. So thank you very much for your time, everybody. I hope we enjoyed the class. By God's grace, tomorrow, 5 a.m., we'll be meeting again, where we will continue from where we are stopped on IFRS 15. And